$4 trillion in U.S. government debt comes due this year. All of it, refinancing at 5%. There are only three ways this ends. And if you're holding dollars, all three come out of your pocket. And when you start thinking about what this could do to crypto, it may blow your mind. Watch this.
You've heard the number, 39 trillion in national debt. You've seen the headlines, $1 trillion a year in interest, more than defense spending. You've watched every economist on every channel sound the alarm. The debt is unsustainable. The dollar is weakening. Inflation isn't transitory. You know. But here's what nobody's telling you. What to actually do about it. Every video, every article, every pundit gives you the problem. The debt, the deficit, the debasement. And then it ends. Maybe a vague line about protecting yourself, maybe a gold ad. Nobody walks you through the specific decisions you should be making right now with your cash, your investments, your debt, and your daily spending to stop losing ground while the government figures out how to pay a bill it already admitted it can't afford. That's what I'm doing today. The problem first, because you need to understand the three channels the bill arrives through. Then the specific moves, because understanding the problem without acting on it is just watching your purchasing power evaporate. $9.7 trillion in Treasury securities maturing in 2026. The GAO confirmed it. 1/3 of all outstanding federal debt rolling over in a single year. Every dollar of it must be refinanced, not paid off, refinanced, rolled into new debt at whatever interest rate the market demands right now. In 2021, the average rate on outstanding debt was 1.61%. By 2025, it had doubled to 3.36%. The government had a window, 2020, 2021, 2022, to lock in 30-year bonds at rates below 2%. Fix the cost of the debt for a generation. That did not happen. The Treasury borrowed short, bills and notes, 2-year, 5-year, not 30-year bonds. Treasury Secretary Bessent admitted it publicly. June 2025. Why would we do it? We are more than one standard deviation above the long-term rates. The window was missed. The government's own chief financial officer saying on the record that the window to fix this cheaply was missed. The math locked in. The interest alone is now $1 trillion a year, more than defense spending, the second largest line in the federal budget. CBO projects it doubles to $2.1 trillion by 2036. By 2028, interest exceeds Medicare. By 2038, it exceeds all discretionary spending combined. The historian Neil Ferguson put it plainly. Any great power that spends more servicing its debt than on defense ceases to be a great power for very long. The U.S. crossed that threshold. And the bond market just confirmed the problem is real. 2-year, 5-year, and 7-year Treasury auctions all drew weak demand. Primary dealers had to absorb nearly a quarter of the 2-year auction versus their normal 11%. That means institutional buyers stepped back. The 10-year yield rose from 4% to over 4.4%, while the Iran war was escalating. That is anomalous. During geopolitical crises, treasuries normally rally. Investors flee to safety and yields fall. Instead, they sold off. The bond market was telling the government, your fiscal position is a bigger risk than the war. RSM's chief economist, Joseph Rusuelis, named it. Investors' concerns include an unsustainable American fiscal position, rising inflation risk, and a growing uncertainty about war. Foreign buyers are retreating. China's treasury holdings down 19%. Foreign official holdings at their lowest since March 2020. The GAO's own report warned that a diminished dollar roll would weaken demand for treasury securities among foreign investors.
Hey, real quick, if you want to learn about buying crypto like Bitcoin, XRP, Ethereum, but you want to do it safely, you want to do it right, you want to save a ton of time and money, links down below to the Bitcoin and Security Bundle. It is everything you need, and a lot of people have watched those courses that have been into crypto for years, and they couldn't believe all of the nuggets of information that they picked up and things that they weren't doing that actually could have caused them to lose their crypto. Links down below. It'll blow your mind. Now, let's get back to the video.
The money isn't going back into treasuries, it's going into gold. 3 channels this reaches your wallet, all 3 running simultaneously. Channel 1, taxes, already happening. Tariff revenues ran 4 times the prior year in the first 5 months of fiscal 2026, a $109 billion increase. Xuan, that's a tax on imported goods paid by you at the register. If tariffs aren't enough, income taxes, corporate taxes, or new levies on savings are next. Channel 2, debasement. The dollar buys less. DXY below 99. OECD revised US inflation to 4.2% for 2026. Your savings account earning 3% is losing purchasing power at 4% inflation. The government's debt stays nominally the same. The dollars you saved get smaller. That's not accidental. That's the mechanism. Inflation is how governments service debts they can't afford. They pay with dollars worth less than the ones they borrowed. Channel 3, crowding out. The government borrowing at this scale competes with you for available capital. Higher treasury yields mean higher mortgage rates. Your mortgage rate isn't high because of the Fed alone. It's high because the government needs the same capital you do. The rate environment isn't cyclical, it's structural. You're not exposed to one of these, you're exposed to all 3 at the same time. The bill arrived. Now here's what you do about it. If you're holding cash, stop losing. Cash sitting in a standard savings account earning under 1% is losing purchasing power every single day. At 4% inflation, your dollar loses a quarter of its value in 7 years. That's not a theory, that's the rule of 72. Online banks are paying 4 to 4.5%. That's the difference between losing 3% a year and breaking even. One account change, immediate impact. I bonds, Series I savings bonds from the US Treasury. They're designed to keep pace with inflation by construction, up to $10,000 per person per year at Treasury Direct, for money you won't need in the next year. There is no instrument with better inflation protection at 0 credit risk. Use the product that hedges against the inflation it's creating. Short-term treasuries, 3-month to 1-year treasury bills paying above 3.5%. The interest is exempt from state and local income tax. The goal isn't to get rich on your cash. The goal is to stop losing. Moving it costs nothing. There's no reason to let cash erode except not knowing it's happening. If you're investing, the traditional 60-40 portfolio was built for a world where inflation stayed low and rates fell for 40 years. That world is over. When inflation is the enemy, stocks and bonds can fall together. The 40% that was supposed to be safe isn't safe when the government is debasing capital. Gold. Central banks worldwide added 254 tons through October alone. Gold maintains purchasing power when the currency loses it. An ounce of gold in 1995 cost $380. The same ounce is above $4,300. The gold didn't change, the dollars did. Bitcoin. Volatile, real risk. But with a capped supply of 21 million coins, it's functioning as a debasement hedge. Fixed supply against an expanding money supply. Commodities, oil, copper, agricultural products. When currency weakens, commodities priced in that currency rise. They are the thermometer for currency health. Real estate, complicated right now. But real estate is a real asset that historically appreciates during inflationary periods. Tips: Treasury inflation-protected securities. The principal adjusts with CPI. It's the government's own hedge against the inflation it's creating. The principle doesn't change. Real assets outperform paper assets when the paper is being printed. Doing nothing is the decision to lose purchasing power. If you're in debt, inflation helps debtors. If you have a fixed-rate mortgage, your payment stays the same while the dollars you pay it with get cheaper. If you're carrying credit card debt at 21%, that's the emergency. Eliminate it. Then roll to the next. Guaranteed 21% return. Every purchase on credit right now carries the premium of a government competing with you for capital. Understand the cost of borrowing when the government is the competitor. These aren't dramatic moves. They're the financial equivalent of moving to higher ground when you can see the water rising. The water is rising. The government told you. The trust is broken. Not because the government is evil, because the incentive structure guarantees this outcome. The bill arrives through the tax code. Interest at $1 trillion a year. 3 channels, all running. The trust is broken. Nobody has a plan, just a schedule. But here's what every economic crisis in American history has in common. Every single one produced winners. People who saw the math and acted. Joseph Kennedy sold his stocks before the 1929 crash. He didn't predict the future. He read the present. The math didn't hold, and he moved. Alfred Lee Loomis liquidated everything and put it into treasury bonds and cash. He used the wealth he preserved to fund the technology that helped win a world war. J. Paul Getty bought oil companies during the Depression for practically nothing. He became one of the richest men by buying what others were desperate to unload. Michael Cullen opened the first supermarket in America in 1930. He didn't build for the economy that just ended. He built for the one that was forming. You have something they didn't. You have the data in real time. The GAO report is public. The auction results are public. The math isn't hidden. It's published. The window is open. If there's one thing the Treasury Secretary already taught you, windows close.